Insurers providing European cross-border risk coverage under EU freedom of services legislation are generally liable to insurance premium tax, or IPT. Until recently, though, national tax authorities were turning a blind eye to non-compliant insurers, but this is now changing. To explain why and the implications for insurers, here's Richard Asquith talking to David Riley.
IPT is the new hot tax in Europe that's hitting insurers in all sorts of ways, and everyone's trying to understand the scope. It's very simply a tax on premiums that are written in whatever country it may be, the UK or beyond. And IPT comes in all sorts of different forms around Europe. But as I say, basically it's a tax on the premiums, which unfortunately for the insurer, he becomes liable to both calculate it and then collect it and then pay it over to the appropriate tax authorities.
And how does it work across Europe?
Well, that's the challenge. Unlike many pan-European taxes, such as VAT, for example, there's very limited guidance from Brussels. They've set the basic classes of risk, but beyond that, it's very much down to the individual countries to decide how they wish to implement it. So that creates all sorts of variations. Classically, how most insurers have got around this is they've tended to write global policies with simple underlying contracts in different countries, or they've just gone and ignored the local regulations and on a non-admitted basis.
Is IPT the only levy that insurers should be wary of?
Well, unfortunately not. And if you're finding IPT confusing, then you've got to look at another level below that, where there's a whole cast of characters looking to make additional charges on insurance contracts around Europe. So always you'll see some kind of stamp duty. Fire insurance often attracts fire brigade charges, but then it gets really interesting because you get into a lot of national stereotypes. So my favourite is always the victims of extortion contributions for, as I say, victims of mafia, and in Italy. And also France tends to look for a contribution to its agricultural funds. So as though we're not paying enough already to the common agricultural policy, I'm afraid insurers are queuing up too.
Who could be liable for payment of IPT then? Is it just the insurer, or can the insured or even the broker be involved?
Well, primarily, first up is the insurer, and they're always expected to spot the IPT liability and then pay it over to the local tax authorities. But what the tax authorities have now implemented is a catch-all, which means that the insured is also liable. Now, that becomes a particular challenge because over the years everybody's been avoiding IPT until relatively recently. But the insured, for the most part, do seem to know that they're next in line. So, for example, we find a lot of people around Europe who are being insured under global policies by American insurers. The Americans just ignore this tax and they know they're in line next. Beyond that, the difficulty can be for brokers who tend to be sandwiched in between two, the insurer who should be paying and declaring the tax, and the insured who's potentially liable. So what we see there for the broker is they're getting upward pressure from their clients asking, look, have you taken care of IPT? And whilst it isn't legally the broker's responsibility, there's obviously a client service responsibility there to take care of it.
And this is obviously going to become now more important as the tax authorities take this tax more seriously. What's brought about this change of heart?
Well, very simply, who better to tax than a foreign company? They're not going to squeal too loudly. So that's the first thing. It's really been since the freedom of services have come in. Initially, there wasn't that much cross-border insurance under this type of scheme. But it's really taken off in the past year or two. So tax authorities have spotted this and are really deciding to try and cash in. Also, though, the local associations, the local insurers, they feel that there's a lot of unfair competition coming in from non-compliant insurers. So they likewise have been lobbying the local tax authorities to try and catch out these interlopers coming in on their turf. So it's been very much them as well.
And what sort of methods are the European tax authorities using then to catch out the non-compliant?
Well, this is where it differs from the UK. They've always been able to levy charges. The difference is, and what insurers have failed to spot compared to their home territory, is that the tax authority won't approach the insurer. They won't pop around for a surprise visit. What they'll tend to do is start clocking up the charges and penalties. Now, what's really changed over the past year or two is the tax authorities are taking a more proactive route to that, and they've got a whole bag of tools now to help them, and the most important of those is the Mutual Assistance Directive, which enables tax authorities to talk to each other and share information about insurers. Now, what that means is if an insurer, even if they wish to be compliant, and for example they haven't been compliant for some years, they may approach perhaps the German tax authorities and try and declare. The German tax authorities will certainly check back with the UK tax authorities to see how had the insurer been treating this type of income in the past and whether they should be tax liable or not. Some of the smarter tax authorities are being quite cheeky. They're actually actively approaching insurers and saying, look, we believe you're providing cover in our country. Have you been paying tax? One or two examples, places like Greece, we've seen during direct tax inspections of regular companies, if they spot the insured has a foreign insurance policy, then they'll certainly be asking the insurer, have they been compliant at the same time? And lastly, possibly the easiest, is one of the first steps an insurer must take when providing foreign cover is get passporting rights, and that's simply the right from a local regulator to provide insurance cover. What the tax authority will do is, and you and I can do this, we'll go online to the local regulator's website, and there you can see every time a new insurer is admitted, you can see the name pop up there, and the tax authority will say, well, thank you very much, and give you a call and say, we notice now you're registered locally, have you been paying your tax?
Well, insurers are becoming increasingly concerned about this. Why is compliance so hard?
Like many taxes across Europe, firstly, it's the inconsistencies, and no one really understands some of the details. There isn't really a Tolly's insurance premium tax for Germany book available, and when people try and research some of the details, they get inconsistent answers, whether it's from tax advisors or even the local tax authority. So, for example, we were speaking on a conference call last week to the Luxembourg tax authorities, and they had 4 of their local tax inspectors on the conference call. We were discussing whether a life insurer should be registered locally. And the 4 Luxembourg tax inspectors spent 10 minutes arguing amongst themselves on this conference call whether our client should be registered or not. That's the sort of thing. And then the language is a huge barrier. Most tax authorities are reluctant to speak anything apart from their local language, and certainly won't pick up the phone if you do try to speak English to them. But then it can get comical, whereby, for example, in France, they lost their insurance premium tax inspectors for 3 months whilst they moved building, and no one was able to locate them, so we're still all trying to track them down.
So what happens if a company then does fall foul of the tax authorities, assuming they haven't moved offices and disappeared in between? What sort of measures can be applied against them?
Yes, well, even as I was saying, even if they don't know it, there'll be penalties racking up already, and they can be considerable.
That must be the fear, isn't it, that it's just out of control?
Well, exactly. And beyond that, there is talk of the tax authorities cooperating with the local insurance regulator and to see if any licences could be withdrawn, for example. But that may be some way off.
And why are insurers taking this much more seriously?
Well, most importantly of all is Lloyd's. They're now insisting that all business that goes through their doors is IPT compliant. If not, then they'll simply say no.
What steps can you take to stay on the right side of the various tax authorities and avoid these excessive fines and interest?
Come clean, simple as that, and do it quickly, because as I was saying, the tax authorities are really waking up to the revenue opportunities on this one. And if you don't come clean, they will raise their own assessments, and these can be imaginary figures running into hundreds of thousands of euros, and you have to then backtrack and try and convince them it's otherwise. So simply approaching the tax authorities, get all your numbers in order, have some nice clean spreadsheets that everybody can understand, and what we're finding is many of the tax authorities will simply say fine, we may even waive some of the penalties, just fill in some backdated returns. And also what you should be looking at is in most countries you will need to appoint some kind of local representative to calculate the taxes and pay them over to the authorities. So make sure you get a good one of those who speaks the local language, obviously, but knows if their local IPT inspector has disappeared, as in France.
But above all, don't bury your head in the sand.
Absolutely.
Yes,
absolutely.
Richard, many thanks for talking to us.
Thank you.